It seems like literally everything is getting more expensive. I went to Trader Joe's yesterday and could not believe that raspberries cost so much. Why do they cost so much? My son is obsessed with these, but he's going to need to find a new favorite snack. Everything is unfortunately getting more expensive, which is placing a ton of pressure on the average household. And in fact, because the purchasing power of our money has gone down so much due to inflation, people have increasingly been using debt rather than cash to fund their purchases. Bloomberg wrote last month, Americans are putting more on their credit cards and taking out fewer mortgages as they need to increasingly borrow to cover the higher cost of everyday essentials. Even scarier, household debt recently rose to $16 trillion, a new record, which means the average household is not paying off their credit cards each month. Credit cards are totally fine to use, right? I love them, but they're not okay to use when you cannot make the full payment and need to roll over your balance the next month. That's a scary spiral downhill. Clearly, we're seeing more of this recently. And if you're feeling the pain of inflation and have been using more debt to pay for your everyday purchases or bills, you're not alone, and we will get through this together. This leads us to today's topic, debt consolidation, which is one of the tools that you can use to reduce your debt load and pay it off faster. According to Experian, the average American has 4 credit cards. 4 credit cards means 4 monthly payments and 4 potentially different interest rates to keep track of if you cannot pay off your full balance each month. Remember, if you pay off your balance each month, you don't have to worry about interest or late fees. So what exactly is debt consolidation? You can probably guess what it is just based off the name, but debt consolidation helps simplify your financial life by merging multiple bills into a single monthly payment. It can reduce the overall interest rate on your debt, make your payments more manageable, and even shorten the payment period. Now, before we talk about the 5 specific ways to consolidate your debt, it's important to know that debt consolidation is not for everyone. Here are some things to think about before starting that debt consolidation process. First of all, if the debt that was built up was because of impulsive spending or excessive shopping or non-essentials, it's likely that the debt consolidation is not a good option for you. It's important to know that debt consolidation is not a magic spell that solves all of your debt problems. If your debt was caused by bad spending habits, consolidation will not help much, because it's likely that you're going to get in the same bad spending habits that caused the debt in the first place, and that will lead to even more missed payments and even more debt. If you're in this position, I would strongly recommend just working on sticking or making a budget that you can actually follow and stop using credit. You should also note that if you can pay off your debts in less than a year and a half or so, you probably do not need to consolidate your debt. In this case, the extra fees and time associated with obtaining debt consolidation likely will not offset the benefits and probably won't be worth it. And if you're here, great job, you're almost at the finish line, so keep going. Next, you gotta make sure that your credit score is good enough to qualify for a 0% credit card or low interest debt consolidation. You'll probably need at least 690 or better on the FICO scale, although we like to aim for 720 plus just to be safe. Lastly, make sure that your income or cash flow can consistently cover your debt payments. If you cannot keep up with your payments now, the cycle of debt will continue and the debt consolidation strategy likely will not work. All right, so if you made it this far in the video, chances are that debt consolidation is right for you. There are many different ways to consolidate your debt, but some ways are honestly better than others. We'll get to that in a bit. In general, there are 2 broad types of debt consolidation loans, secured and unsecured loans. Secured loans are backed by the borrower's assets, such as the house, car, or even your investment portfolio, which is used as collateral for the loan. On the other hand, unsecured loans are not backed by any asset and can be more difficult to obtain. Unsecured loans tend to have higher interest rates and lower qualifying amounts compared to the secured loans because the lender does not have any asset as a guarantee that this loan will actually be repaid. With either type of consolidation loan, their interest rates are still typically lower than the rates charged on credit card. In addition, these interest rates are fixed, so they will not vary over time if the economy changes. Credit card rates are typically variable rates. So the first way to effectively pay off debt is to get a balance transfer credit card. This option is really great because these cards typically have a 0% APR offer for a certain promotional period, typically anywhere from 12 to 18 months. This gives you the perfect opportunity to pay your debt completely before that 0% period expires. However, it's important to make sure that the 0% APR promotion applies to balance transfers, as some 0% promotions like this only apply to new purchases. Is there anyone else in your life that could benefit from this video? Hit subscribe and share it with them. They'll really appreciate it. Another thing to know is that oftentimes credit card issuers will charge you a one-time balance transfer fee of 3% to 5% of the amount transferred. So before you choose a balance transfer card, be sure to calculate whether the amount you save over time by transferring balances is greater than the cost of the transfer fee. To repay your credit card balance under this promotional period, you only need to make the minimum monthly payment and then need to pay off the balance in full at the end of the promotional period. Typically, that minimum payment is about 1% of the balance each month. If you'd rather just make a fixed monthly payment on the balance for the peace of mind, that makes sense too. Just know that you don't have to. One of the benefits of using a balance transfer credit card is that you could use this as a way to defer some of that debt down the road. Basically, it gives you a fresh start, a little refresh at tackling that debt. However, credit card transfers can also have some downsides that you absolutely need to be aware of. First of all, if you don't pay off the balance transferred in full during the promotional period, you could actually end up paying way more interest on that balance. So before getting a transfer credit card, make sure that you'll actually be able to pay off your debt before that promotional period ends. Something else to pay attention to is the balance transfer fees and the annual fees that some credit cards may have. As I mentioned before, just make sure that the amount you save from transferring balances is greater than the fees that you'll pay. Overall, transferring your credit card debt to one balance transfer credit card is one of the best options, but you will need a good to excellent credit score to qualify for most of these cards, which is typically higher than 690. Another way to consolidate your debt is to get a credit card consolidation loan. This is simply a personal loan that can be used to pay off your existing credit card debt and restructure your debt into a single fixed monthly payment. You can get an unsecured personal loan from a credit union, bank, or online lending company to consolidate your debt. And typically, these personal loans will give you an APR that's lower than your credit card's APR. Like most things, the better your credit score, the lower your interest rate will be. So some of you might be thinking, won't taking out a personal loan hurt your credit score? Okay, fair, that's a good question. Yes, it is possible that it could hurt your credit score initially in the short term. However, if you make all your payments on time, your payment history can actually improve with this. And since your payment history accounts for about 35% of your total credit score, this could definitely help improve your credit score down the road. And if you're wondering, when that debt is reported as settled or paid off, it will stay on a credit report for 7 years from the date of settlement if there are not any late payments. There are some cons that you want to be aware of before looking at these type of loans. First, there might be some fees when you apply. There typically are, including transfer fees, application fees, annual fees, and termination fee. If you have a low credit score, there are still some opportunities for you to consolidate your debt with other options. Debt management plans roll debt from different sources into one monthly payment at a reduced interest rate. Unlike other debt consolidation methods, debt management plans don't have any credit requirement. These plans are offered by nonprofit credit counseling agencies who do a detailed analysis of your income and expenses in order to create a budget that includes a fixed monthly payment customized to what you can afford. This plan is then presented to credit card companies on your behalf, who will approve or deny this plan. With this plan, you begin making monthly payments to the credit counseling agency directly, who will then use that money to pay the debt according to the predetermined payment schedule developed by the counseling agency and your creditors. They pay the credit cards on your behalf. Most payment plans are designed to be completed in 5 years or less. And there are some pretty big pros and cons to debt management plans, so it's important you know both sides before utilizing this program. Starting with the cons. Before starting the program, you'll be required to close the credit card accounts that are part of the debt management plan. This is done to avoid taking on any more debt, and you'll also be forbidden from opening new lines of credit as well. Even if you have a credit card that's not part of the debt management plan, you'll likely be advised not to use it except for emergencies. Next, sometimes very rarely, credit card companies will not approve this plan, which means there's a chance that you'll pay some creditors separately from the monthly debt management plan payment. So if you have like 4 credit cards and only 3 of them accept, you gotta worry about that 4th credit card as well. Lastly, it's likely that the credit counseling agency that you're working with will charge a fee, sometimes monthly, for their services. If this fee is worth it for you to get out of this debt cycle, this makes sense. However, you should be aware of all the potential fees and weigh those benefits you get for those fees. Moving on to the pros, a debt management plan can actually help improve your credit score. Money Management International, a debt management plan provider, found that clients improved their credit score by an average of 62 points 2 years after starting this debt management plan. This is likely because being part of the plan helps you stay more organized and on time with bills and payments. Being part of a debt management plan can also give you guidance from a professional and will give you a clear picture of your plan to get rid of debt. So, if you have a low credit score but want to consolidate your debt, you might consider the debt management plan. All right, hope this video helped. Thanks for watching. I'm Tony from Wealthfront. Take care.